Hello, fellow investors. Welcome to Nordic Finans, where we help you realize your financial goals.
So if that's something you find interesting, please invest in the subscribe button and deposit a like on the video. My name is Marcus.
And I'm Lucas, and today we're going to talk about PE ratio, simply explained for beginners. But before we get into the video, please let us know down in the comments, do you consider yourself to be a short-term or a long-term investor? Let us know, short or long, down in the comments below. Okay, so let's get into it. PE ratio explained for beginners. Let's start with a definition, shall we, Marcus?
Yeah, I would just begin also by saying that this is one of the most important ratios that you could start with as a beginning investor. So if you're gonna know a ratio, I think this is the one.
Yeah, let's get into the definition. What is the PE ratio? Well, the price to earnings ratio, or the PE ratio, is the ratio for valuing a company that measures its current share price relative to its per share earnings, EPS. The price to earnings ratio is also sometimes known as the price multiple or the earnings multiple. Okay, so that's quite a mouthful, and
It's a lot to unpack.
if you're like me, you didn't really understand what was going on there. So luckily we have Marcus here, who actually studies these things to further unpack it for us.
Yeah, my major is not finance, but I have some basic concepts at least of how this should be used to an extent. We're gonna talk more about it further in the video. So what we got there first is the EPS ratio, which is usually a ratio that can be used by itself as well. And that is the company's earnings per share that they have issued, so that they have out on the market, so to speak. What the PE ratio does is that it takes into account what the total value of this whole company, so like all the equity that there is in this company, so all the shareholders and all their shares, what the value of that is together, and then divide it by the earnings for a particular year. And then you can see how long would it take for this company with the current earnings to justify what you pay for this share today. So basically it's a way to measure how the price of a stock is right today, and whether it's a good deal today or if it's, so to speak, overpriced.
Let me bring it back to basics real quick here, because here's the thing that you might think. What do you mean if the company is overvalued or not, or the stock is overvalued? Because maybe you just look at the share price, that, okay, yesterday was $30, today it's 20. So clearly it's cheaper than yesterday, which is true. But here's like the problem where you can't just look at the price of the share, because how many shares are in the market? That's going to affect it a lot as well. Is the company even earning any money? That's going to affect things as well, if it's a good buy or not. I think an easy way to look at it is trying to bind it to something more real. I think we can all understand rental properties to some extent, at least, because most of us have rented an apartment for some time of our lives. So say that you would buy an apartment. What this sort of tells you, not in the exact same way, but kind of, it's telling you how long it's going to take at the current earnings for the rent to pay back the price that you've paid for an apartment, if you try to liken it to that of rental properties.
Yeah, so how long would you have to collect the current rent in order to pay back the whole apartment?
Yeah, exactly. That's what I'm trying to say.
Yeah.
Only that instead of rent and an apartment, it's earnings, like what the company earns and what the company is currently valued at.
Yeah, I think that's a good way of phrasing it, because actually PE ratios can be very complex. Because, for instance, if a company doesn't have an earnings for a particular year, you actually can't calculate the PE ratio because it's a necessary step. So, but to keep it simple, I would say that the way Lucas described it is very good for the simpler versions of the PE ratios. And it's basically a way to measure how fairly the share is currently priced, so to speak.
Yes, it's a way for you to just, at face value, get some sort of understanding if this is cheap or if it's expensive.
Yeah, I just want to add one final thing that could be interesting, and we probably will touch more upon in the future. When it comes to finance, these price multiples or earnings multiples that is mentioned here in the PowerPoint is usually a thing that investors use a lot when measuring companies. We're not going to get into specifics into how these multiples are calculated, but they're a good thing to be aware of if you see them, for instance, in annual reports or investor presentations or stuff like that. Then multiples are usually what it says, like a multiple on how you should value a companies, but they can be very difficult to calculate, so we're not going to get into them in this video.
But now let us move on to the next slide, which is how to actually calculate and how to find the PE ratio.
Yep. So here we got a few suggestions. There are PE calculators online that you can actually just type in, for instance, the equity and then the earnings for a particular company, and then it will calculate the PE for you. These are very similar to MarketBeats, DeGiro, Yahoo Finance, and other paid services that actually provide you with a ready-made PE value. So they have basically calculated it for you, and you can just check it, like what is it. However, I do want to have a massive caveat here, especially if you're not using paid services, is that these can be extremely unreliable at times, and they might often be outdated, so they're not very accurate at the current time. I use actually the one at DeGiro, but only like sparingly. I only glance at it to see like, okay, what is DeGiro saying right now? It's not like I actually trust it, because I don't think it's kept up to date. And because PE ratios can sometimes be based partly on estimations, they can vary from site to site, especially also the timing aspect can vary from site to site based on when did they calculate the PE ratio. So if you are using these services or sites that provide them, be very cautious sometimes. And if you are paying for services, they might be more reliable. I think Yahoo Finance is probably one of the most reliable that are free, but I wouldn't count too much on them, so to speak.
Yeah, I agree with that. But usually with just like a simple Google search, you can find at least something, and it usually like points you in a direction.
In the direction, yes, of course.
Yeah,
I agree.
yes,
like it's points you in the right direction, but I wouldn't bet my house on it, so to speak.
No, exactly. But usually you don't even have to. Usually you're gonna be in a really good position, for example, for screening purposes, just to
just
sort
look
out
what
the bad ones. Yeah.
Exactly. They are mostly used for sorting out the bad ones, and maybe they can catch your interest, and you can dig further into a company if you find a particularly good PE ratio, for instance. Then you can more look, oh, this is interesting, and look more into it. But you shouldn't base your investment decision solely on the PE ratio. It's just like first point of interest, so to speak.
Exactly, that's a good way to put it.
Another way you can actually do it, but this is more cumbersome, is that you actually go into annual reports of companies and you calculate it by yourself. You use the market cap divided by the earnings at the time you are interested of calculating this PE ratio. Then sometimes the PE ratio can even be mentioned in the annual report if you look at that one. That is the company itself that I calculated the PE ratio. You can also sometimes find something called the trailing PE ratios and the projected PE ratios. We're not going to get into more detail of what those are in this video. We're probably going to make other videos about those. But there are many different ways of calculating these PE ratios, and they are used in different ways. But they usually have a mention of their current PE ratio. What you should just bear in mind is that when these are published in the annual reports, they are usually outdated, because this means that the PE ratio was calculated at the time of the annual report. So just bear that in mind if you want to use them. When you're using the PE ratios, try to use one that is quite accurate, or as accurate as possible anyway. All right, but now I think we are ready to move on how to actually use the PE ratio.
Okay, so now we can move on to how to actually use the PE ratio and how to understand what it actually is. And my beautiful metaphor with the apartment gave you some idea, but here's an even better idea of what it is and how you can use it. So simply put, what is the actual price of the share? What are we actually paying for when we buy a share? We're buying a piece of a company, we're buying an asset that produces money. So as I said, how long will the individual share take for it to earn back the money? Of course, this is not money that you're going to get necessarily. If it's not like dividend, then you're going to get part of the money. But since the share earns money, that money usually goes back into the company, which further appreciates the share. So this is why the lower the PE, the cheaper sort of the share is. Then if you would have a company with a super high PE rate, then at the current earning rate, it's going to take a super long time. Like sometimes you can have companies that I looked at Fiverr the other day, and it was like, this wasn't like an exact PE ratio, but it was like, again, in the ballpark, and it was like 1000x or something. So at Fiverr's current earning, if I pay the current share price, I would have to live until 1025 until I make my money back. Like, do you see how insane that is? And so you can quickly see what would be the problem with that. That doesn't mean that it's a bad company if you feel like it has potential to earn a lot of money.
And one short thing I want to add about the PE ratio is that it generally doesn't take growth into account. That is, I think,
Exactly.
also what Lucan is trying to say, that because PE ratios is just based on what the company is earning now, it is not based on what the company will be earning in 10 years. So even if a company, say a tech company, has a very high PE ratio, it might be justified because maybe the company is not earning so much right now, but it could be earning a lot in 10 years. And then it would be justified that it has a high PE today because investors are counting on the fact that in 10 years, this company, it will earn 20 times as much money as now, maybe even 50, 100 times as much as now. And that is why it has such a high PE in some cases. But this can also be very worrisome because some tech companies, as you probably understand, might not be earning 50 times what its current revenue in 20 years. So it's a massive gamble in that sense. But some general advice to close out this segment is that for the long term, you want the PE to be low. Say that you're investing in like Coca-Cola or Disney or like these big companies that probably are going to be around for a very, very long time. They are not probably going to double or triple their revenue in the short term. But especially if you could find a time period where the PE would be low for these companies, it could be a good idea to get in then and make sure that you are not paying too much for the share based on their earnings, at least at that time, and then keep it for a very long time and possibly, for instance, buy the shares relatively cheap at that time and then collect dividends for a long period of time. Because if the PE ratio is high in companies like Disney or Coca-Cola or something like that, it might indicate that it's not a good time to invest into these companies right now. You should wait when people are less hyped, so to speak, about this company. Because the hype is sometimes what's driving the price, for instance.
Yeah. But I think we can now summarize this video, and like these are going to be the most important things that you're going to want to take away from this video. So if you don't remember anything else from today, that's fine, but remember these things. So first of all, the PE ratio is going to be a way for you to evaluate how long it will take for a company with the current earnings to fully justify the price you pay today. Again, with the apartment that you buy versus the rent that it has to collect for you until it's paid for itself. That's sort of at least the general idea of it. But again, as we said in this video, you do not want to just blindly stare at it, because it's not going to take into account, is this a small company that maybe is not really making any money yet, but it probably will be in the soon future. It's not going to take into account growth. There are projected PE value as well, which we didn't really talk about here, and we're not gonna, but we can do separate videos then in the future about trailing as well as projected PE ratios.
Yeah, one last thing about the PE ratio that is really good to remember is that it does not take into account companies that have negative earnings or something like this. And this is particularly bad in the sense that companies might just have a bad year and then they don't have a PE ratio. That's not really necessarily a bad thing for a company. I mean, there are better and worse years for companies as well. So even if a company has no PE ratio, it might be a good time even to invest into it because the price might be a bit lower since the company is not making money that year. So do not like blindly stare at it and think that, oh, this company doesn't even have a PE ratio, then it must be a bad investment.
Yeah, so actually what Marcus, I think, is trying to say there, or another way to put it is that, say, for example, that a company just has a terrible year. It's still a good company, but just somehow it just goes terribly, or they invest a lot of the profits back into the company or whatever. So maybe the price goes down, but the earnings go down so much as well that year. But it's probably going to be specific for that year. That still means that it's probably a good year to buy the company because it's just reinvested a lot of money into itself or whatever the reason. But it depends, right? So this is why you can't just look at this ratio. You have to look at other things as well. Is that what you were trying to say?
Yeah, and basically that the PE ratio is usually very limited in the sense that it thinks about this year or very like short term in the sense that if you have this earnings like for a very long time, so of course a company that has negative earnings, it's not going to be in business if it has negative earnings every year, you know. But
Yes.
what usually happens is that these companies turn around and they become profitable again, and then it might have been a good idea to invest while they were actually down a little bit and the price was not so high.
Exactly. That's perfect. That's a really good point. Yeah. Okay, but moving on then as well, our third point here that you need to know is that as a long-term investor, PE in general is going to be more important to be aware of, especially when it comes to like well-established companies, such as we just mentioned Coca-Cola and Disney. We talked about them earlier, but other well-established companies as well. But again, like aggressive growth, it's not really going to make any sense to look at it too much. The one time it might make some sense to look at PE ratios is if you want to compare them to the industry average. That's usually like a good thing to at least look at it. But if it's a super new company and it's probably going to grow a lot within the next years and you have reasons to believe that it's going to grow a lot in the next years, maybe don't look too much at it unless it's some like insane number. And then finally, in summary, if nothing else, at least know this, like I already like saved myself like doing a bad investment because I knew this part alone. Low PE often good, high PE often bad. It doesn't get better than like some monkey logic at the end.
Yeah, and this of course, like we all already mentioned in this video, is not always true, but it's a good frame of reference, especially if you're investing in well-established companies and for the long term. And then here at the end, I would ask you, the viewer, a question. What do you think about the PE? Is it, now that we have presented it, is it something that you will consider? Do you think that it sounds like a good and valuable ratio to use? Or are you more critical about the PE? I know that we have also presented a lot of criticism almost to an extent to the PE and how it cannot be used and what it doesn't take into account. What do you think about what we said in this video? Please let us know in the comment down below.
Yeah, and please, if you had any value from this, and I promise you will have value from this if you apply it. That's always important. Like, you need to apply these things as well. You can't just listen to this and just go on with your day. You should apply it. But you're going to have a lot of value from this. So please, if you like the video, give us a like, give us a sub maybe, just a little sub maybe.
Yeah, we're closing on 100.
Yeah, and we're going to do, I don't know if we said this already, but on 100 we're going to do a special live stream Q&A, and we're just going to talk about general things as well. But then everyone who like turns up and want to ask us question, you can do that, but then we're going to talk about like general things as well during the time. So that's going to be super fun, so we're looking forward to that. But we need to get to 100 first, so give us that sub, please. Okay, enough begging. Enough begging. Hope you enjoyed today's episode where we discussed the PE ratio, what it is, how you can use it, how you can calculate it, all that good stuff. Again, my name is Lucas. I've been joined by
Marcus.
And as always, all that's left for me to do now is wish you guys happy investing.
Happy investing, guys. And watch those PEs.
Yeah, watch them PEs. Low PE good, high PE bad.